to top it all, you have, of course, the Yes Bank fiasco as well. As we do know, with Yes Bank essentially putting in that moratorium, the government as well saying that, look, SBI is going to take over, pump in a good 49% of the equity into Yes Bank. This in turn does bring about the question that what about the mutual funds that are exposed to Yes Bank from the debt side as well as for the equity side, and more particularly for the debt side, because that's where the write down has essentially come in. But coming back to the entire market carnage, a couple of funds have actually lost out on their NAV significantly, and I just want to pull that up on a Y-to-D basis. We have some data we've compiled with Morningstar, and yes, Nippon has taken a large chunk of the hit over there, perhaps because of the whole Yes Bank thing. But yeah, you look at the UTI Credit Risk Fund, it's down 25% YTD. The Nippon India Hybrid and Focused Equity Fund is gone. ELSS as well is gone. In fact, it's surprising to see that in this list of some of the top 10 NAV losers year to date, the HDFC Tax Saver and the Nippon India ELSS Fund, both of them have featured on the list, losing almost 16.5% and 18% respectively. And I suppose it's not surprising to see a credit risk fund top that list 25% gone, because there have been several credit events. When I say credit events, the inability of an individual, of a company to be able to repay money, and credit risk funds, as we know, bets on the credit worthiness of a corporate, and that's really not been essentially the best. Credit risk fund, of course, takes a contrary approach. It bets on slightly riskier assets because they believe that maybe times have changed. But when they do make money, they make money big time. When they lose money like this, 25% gone from January 1st, Jan 2020. Now, if your fund features on this list, or you're still basically not making money on your fund because of perhaps the market carnage or whatever be the reason, let's understand what you should do, if you should do anything, that is, in the first place. Anil Rego of Right Horizons joins us now on the show. Mr. Rego, always a pleasure having you with us on the Money Show. I think I'm sure many of your clients as well have contacted you saying that, the market's in absolute carnage mode. Whichever stock you look at, it's falling. The markets have been falling. Now the question is, are my mutual funds hurt? Am I in the green? Am I still making money, or am I losing money? And if that's the case, should I just pull out and save my losses? Mr. Rego, this is a question on a lot of our viewers' minds. How would you essentially ask them to read into the headlines that we are seeing today from the markets because of coronavirus, among other things? How should a mutual fund investor read into the headlines that we are seeing today?
Definitely, the correction has been reasonable this time, and we've seen a 15% correction from the peak. And you also showed data just for 1 month, which sort of coincides is somewhat similar number. Now, the way I look at it is, the point is, when should you be actually selling? Okay, possibly when, things are doing well and you are closer to the peak, etc. That is a better time for you to be booking profits. Now, after the market has already come down, okay, the question is, what should we do? Should we really do it? There's always this fear that, markets may go down further and let me, take out money and possibly I will not lose any further money. Now, this is precisely the reason, why if you look at data on, fund flows into equities and out of equities, it will be interesting that at highs, people put in money into the market, and at lows, actually people end up pulling out money. And it is because of this fear that, you see this type of data. Now, and because of fear and greed, markets tempt you to actually, do the opposite of what you should be doing. So, our view is, is that we need to look at a slightly more disciplined investing style. Ideally, risk is something you should think of in good times, and in good times ensure that, you have a good asset allocation. There will always be factors at times like these which will spook you. Not only Indian, global as well. But, the correction now has been reasonable. And I think from here, possibly, the risk is on the upside. That is, you sell off, and you may just find that markets end up going up. So on the downside, you may see a little bit of fall or volatility here or there, because there are factors like the coronavirus, which would, I think, continue for some time. However, the good news is that if you look back and see what has happened in China, after a period of sort of spikes, you'll find that things sort of get under control, and you'll find the virus also plateauing out. And again, you go back and study data, what has happened on such outbreaks in the past. During these periods, there is volatility, and subsequently, markets end up pulling back because factors like this, yes, they will impact the economy in that period because maybe production will come down, consumption will come down, and that may impact the economy, it may impact companies. But the question is whether it's a longer term impact. Yeah, there are global factors like oil, which, if it continues to go down, can impact countries like the US, which are today is the largest producer of oil. So one needs to be having a balanced portfolio. So at a time like this, I still think that it's a good time to go and average out. If you are doing your SIPs, continue with the SIPs. Ideally, I hope you had some debt funds. The value of gold in your portfolio actually, as an asset class, comes in at periods like these. And that is why it's good to also have some bit of allocation to gold, and even especially in periods when, say, markets are doing well. At that time, gold may not show good past returns, but the whole point is you are buying portfolio insurance by using gold. So I think at a point like this, I think you need to stay calm, okay, and possibly shut off a little bit of those messages on social media, etc., which will spook you. Because there are certain parameters that also make us think that in the short to medium term also, there will be pullbacks on the market, and I think there's you need to be cautious, but I think need not worry too much.
So basically, Mr. Rego, you advise that right now investors just simply stay put with whatever they have. But if they don't have gold, do you recommend they buy right now, because gold prices have gone up quite high? But nevertheless, would you still say that any time is a good time to buy gold?
Unfortunately, yes, gold prices have gone up. So it is less. It's slightly more risky than what it was some time back. But I think, and that also could be a more volatile. When equity markets come back, you may find that it also takes a bit of it eases out a little bit. So I think the best strategy to look at it is maybe do some bit of systematic stuff in gold, and so this can be a little bit of portfolio insurance for you for the future. Let's say if markets continue to fall, and you actually see a much larger correction on markets, a whole cycle turning down. Okay, then at times like this, gold may sort of do better. But just to give you an example, also for most of us, right? What do we do when our real estate property prices fall down, right? So I think you'll just sit back and say, okay, this is not a good time. So I think that's an attitude we should also take with mutual funds. And at times when it is good, yes, I think some booking profits is something that you should also plan in a portfolio. But at times like these, maybe just sit back and sit tight.
Okay, just sit tight right now. Now is not essentially the time to panic. That's the word then from Mr. Rego. What about Yes Bank, Mr. Rego? We've seen NAVs really crash over there in just a matter of 2 days. Nippon, etc., have seen some of their mutual funds really be whacked out of shape. They've written it down to zero. That's what many of them have said, that the value of it has already been written down to zero and the NAV has already fallen. So all the more, Mr. Rego, for such individuals, do you think they should still redeem their funds or be patient, because the worst is they've already suffered through the worst?
You see, today, if I just look at Yes Bank, I think about 42 schemes, debt schemes have got impacted, by this fiasco. And of course, maybe it's a slightly overhyped as well. Okay, because there are few schemes, yes, which have seen very, very sharp falls, and Nippon is just one example that you put up on the screen, right? Even UTI credit restriction, is another one which was there. And if you see, out of these 42 schemes, about 16 of them actually fell more than 3%, and 11 of them fell more than 2%. Okay, so, and I'm assuming that this 2% will sort of, or 3% will sort of eat into your returns a little bit. So something which is lower, you may not erode capital. Okay, but there are definitely some of them which have impacted, and that is unfortunate and a huge point of concern. Now, I'm coming back to, again, maybe the fundamentals of it, which is important for us to understand. Because if I also look at the whole range of debt schemes, you'll find a number of them, and I think a large number of them which actually have done very well. Okay, many of them even a medium term. I mean, not even looking at longer duration funds. Okay, short term and medium term funds and ultra short term funds. Many of them have delivered somewhere between 8 to almost 10%. There are ones which have been outliers and done even better than that. But this is the point I'm making, that we need to understand debt mutual funds are a little more complex than your bank fixed deposit. You have the whole range with you. The most risky was the credit risk funds, and you will see that those are the ones which are mainly impacted. You had one or two others as well, corporate bond funds, etc., which have got impacted. Okay, but the main is credit risk funds. And when does an investor invest in credit risk fund? You are taking actually a much higher level of risk. You're saying, you know what, I want a higher return, and I don't mind taking a higher level of risk. Now, we do not suggest too much of them to clients, because we believe many times you are investing in debt to be safe, right? So we rather be a lot more safer. And so whenever you're looking at any debt fund, please go back and look at one aspect also. What are the underlying bonds that they have? What is the credit rating of those bonds on an average? And then invest. Also, go back and see. I think this is a good lesson for us to look back at maybe which are the funds which have been impacted, because you have a lot of fund houses. You have few fund houses which have been impeccable. Okay, so I think as an asset class, it is important to understand that there could be defaults. And if you choose a credit risk fund, it may give you good returns. In earlier, when they were doing very well, many investors saw those returns and went into them. Unfortunately, fund managers also ended up taking a more higher level of risk to generate extra alpha, and that in the end, you're seeing the consequences of that now. So in a cycle which is not great for the economy, that time you will find some of these come down. So I think it's important for investors to look at what are the schemes they have. Debt mutual funds in itself actually are a fantastic avenue. Even if you go back and look at your own portfolios, probably if you have a series of them, you'll find most of them have done reasonably well. Okay, but the ones which have taken a higher level of risk are the ones which have sort of got impacted. So it's not a broad paintbrush that you put out there, but it's more to be specific and find out which are the ones you should not be investing in and which are the ones you should be actually looking at.
Yeah, well, obviously with greater risk comes greater returns, and vice versa as well. So it's but obvious that that's going to be the phenomena we see. Okay, let's Kickstarter Ask the Money Show segment, where we take on board your questions and queries. So folks, if you have any queries on your funds, on the mutual funds that you have, or any personal finance related query, Anil Rego is here to get them answered. The Money Show at ET.TV is where you could email us, or you can just call us on 24990300. Shankha Sen from Andhra Pradesh joins us now on the phone line. Shankha ji, good evening. Thank you for calling in. आपका क्या question है?
Thank you. Thanks for selecting me, giving me the opportunity. Thanks a lot.
Pleasure, sir.
I have been investing since November 2018. Okay. I am 37 years old. Since last 1 year, 4 months, I am investing rupees 20,000.
Okay.
And these 5 mutual funds are there. Parag Parikh Multicap 4,000, Kotak Standard Multicap 4,000, SBI Small Cap 4,000,
okay.
Axis Growth Opportunities Fund, that is the large and mid cap 4,000, and Mirae Asset Mid Cap 4,000 rupees. Okay. So I will increase my SIPs by 10 to 15%. Even I am doing top up.
Okay.
As the Sensex and Nifty is going down, apart from my SIP dates, I am doing top up of 2,000 rupees or 1,500 rupees in my running SIPs.
Okay.
I will increase my SIPs by 10 to 15% depending upon my annual increment.
True.
Main problem is there, madam. I am expecting 3.5 to 4 crores till 2043. My retirement is on March 2043.
So 23 years from now. Okay.
March 2043.
Okay.
23 years from now. So I want 3.5 to 4 crores. So how is my portfolio? This is my first question. These are the 5 funds, 20,000 rupees. Since last 1 year, 4 months, I am investing. 37 years old.
Okay,
I am already taking care of my debt portfolio. And on another question is Kotak Standard Multicap का मैडम 31,000 crores हो चुका है already.
The AUM, yes.
प्रॉब्लम आएगा क्या रिटर्न में? हाँ, फ्यूचर में कोई प्रॉब्लम आएगा क्या? क्योंकि कोई दूसरा मल्टी कैप फंड अगर हम लेते हैं मैडम, क्या है जीरो से चालू करना पड़ता है, आई हैव टू स्टार्ट फ्रॉम जीरो। तो कंपाउंडिंग का इफेक्ट आने में बहुत टाइम लगता है। और बैंकिंग के स्टॉक्स सब कॉमन रहते हैं लगभग। दूसरा मल्टी कैप में कोटक के जगह लेता हूँ, एक तो जीरो से चालू करना पड़ता है, कंपाउंडिंग का असर कम हो जाता है, धीरे धीरे टाइम लगता है। और फिर कॉमन पोर्टफोलियो रहता है, स्टॉक्स का ओवरलैप रहती है। तो जरा ये सवाल थे मेरे। हाँ, वो ये जरा बताइए। मैं टॉपअप भी कर रहा हूँ,
ठीक है।
आई एम एग्रेसिव इन्वेस्टर, मैं टॉपअप भी कर रहा हूँ। जब अभी सेंसेक्स गिरा था, निफ्टी गिरा था,
yes, of course. Okay, that's a good thing to do. So I think वैसे you are following the right path by increasing your SIP as well. जैसे आपका income increase हो रहा है, you should increase your SIP as well. Now 3.5 to 4 crore rupees is what he wants to accumulate in the next 23 years. He's already got a nice SIP of 20,000 rupees per month going. So yeah, his first question of course is to just peruse his fund, Mr. Rego, if you could do that. And the second question, the size of the AUM. Do you think Mr. Sen's thinking is correct? If it's a 30,000 crore AUM already there, and you know in other funds you have to start from, I mean maybe not necessarily zero, but you know they are smaller sized funds. Does the return generation process or the compounding process depend on the size of the AUM? You know, it's a great question also that he's brought up. You could perhaps either confirm that or you can also bust that myth for all our other viewers as well, Mr. Rego.
So definitely, you know, I think let me take his first question first. And so today the schemes that he has have been very good. So I must congratulate him. I must also congratulate him for doing a good SIP, and also I like his philosophy of saying that let me increase it in line with inflation, and when he gets a bit of a salary hikes, I'm sure that's when he's doing it. So that's the right approach for many of us to take. At early stages, you'll find that if you compute and say, if I continue with just this 20,000, you will end up with a bit of a deficit out there. Okay, now the ideal requirement is for you to sort of keep on increasing, your SIP over a period of time. So that is one aspect that you should, I think, continue doing, because you will need to almost go back to an average of say 47,500 per month to be able to achieve your goal. So that is something which you can do. On the funds that you have, I'm not suggesting anything else. Maybe you can add the SBI focused fund as an option there. Now coming back to your question of a large fund, right? And Kotak Standard Multicap has done extremely well. So it has gotten a lot of money, and now 30,000 crores, etc. Now what do you do? Now the size of the fund, I think it is important to look at depending on which market cap the particular or the segment that the scheme is. So if you're in a large cap, I think a 30,000 crores would not have been any issue at all. I would still think that a multi-cap fund also you may not have too much of a problem, but yes, what it would do is some of the mid-cap companies that it can invest into will get restricted, because some of those scripts may not be able to take the liquidity that the large fund requires. So from that standpoint, I think still it is not a problem for Kotak Standard Multicap yet. But I think if it goes to 50,000 crores, etc., then one could start reducing and moving out. But anyways, you already have another alternate multi-cap also in your portfolio, so you can keep Kotak Standard Multi-Cap on a bit of a watch list, and where performance starts coming down is where you can move out of it. But if coming back to this size of the fund, if you are into mid caps and small caps, I think the size of the fund becomes very, very important. So for an investor, if you're doing mid and small cap funds, a large fund is definitely a negative, because the whole style and that the scheme is supposed to invest into, it will not allow it to take sufficient exposures to a few scripts that it may want to invest into. So good going, and I think just continue what you're doing. Maybe for Kotak Standard Multicap, you can continue for some more time, and if you see signs of it slowing down, then you can possibly move to some other fund.
Okay, so Shankar, your investing style gets a complete thumbs up. Your portfolio as well gets a complete thumbs up from Mr. Rego. Let's take on board our next query. Aman from New Delhi writes, he's actually calling us right now on the phone line. Hi Aman, good evening. What's your query?
Yeah, good evening. I have 2 to 3 questions.
Sure.
You have my portfolio on the screen right now, or shall I repeat?
Please do repeat your portfolio for our viewers.
Sure. I have the equity portfolio of Axis Multicap 10,000, SBI Focus 20,000, Mirai Focus 10,000, Tata Large and Mid Cap 15,000, DSP Equity Opportunities 10,000, and Invesco Small Cap 15,000. I do have the PPF of 3 lakhs and EPF approximately 5 lakhs in my portfolio.
Okay.
My main question is that if there any subtract or addition in my portfolio,
Sure.
it is requirement from your side, or because I have the long-term goals of 15 years for the retirement, so please advise me, it is advisable to add some also debt profile in my debt component, or there are a lot of debt schemes, low duration and
Yes.
short-term bond funds and corporate bond funds. Should I add into my portfolio? If yes, from your side, please suggest me the funds.
So 8 lakh rupees is already in PPF, EPF, right?
Yes.
And
yes.
what's the quantum of your SIP that you're doing in these 6 funds?
80,000 per month.
In total?
Yes.
Okay, all right. So 80,000 per month in total in 6 equity funds, 8 lakhs in PPF, EPS if he's 15 years away from retirement. So Mr. Rego, would you recommend he throws in more debt into the mix? And also secondly, I mean, we're looking at times where bond yields have been crashing as well. I mean, literally every asset class is crashing, bond yields included. It's expected that, central banks around the world will also cut interest rates to sort of support, the economy amidst the coronavirus scare. So in the midst of all of that, Mr. Rego, how would you essentially, advise him to approach the debt side?
Yeah, so I think he's doing a reasonable job around the equity side, and he's also diversifying it. Most of the schemes are good schemes, so I'll spend a little more time on the debt side as suggested by you as well. Okay, so I think he has 15 years to his requirement, which actually, is not too long either. Because in other 5 years, 10 years, we'll have to start winding down. So what I would think is the first aspect you should look at is what is the right asset allocation for you. And a thumb rule is 100 minus your age. So if you are 40 years old, then you can have 60% equity exposure. So that is the basic principle that you can thumb rule that you can follow. Yes, you do have some bit of that to your PF, etc. But just relook at the overall numbers and see where do you stand, and accordingly, based on your risk profile, you can because the various other factors that you need to consider. Now, definitely, it makes sense to gradually increase the debt over a period of time, and at least 5 years from now, he should start getting a lot more conservative than sort of what he is today. Now, I think at this point of time, the debt yields are not going to be great. You will find that yes, interest rates may sort of come down further, but I think we already are much lower than what we were say a year back. So I would think that the downside in terms of interest rates may be 0.5%, 0.75%. Okay, but then you may also start seeing it move up from there. So and keep in mind that on the debt side, debt funds, 3 years is a long-term capital gain requirement to hold for 3 years. So earlier you may just find that you may end up with short-term capital gains as well. So having a fund which you rotate too much, may be an issue. So one is you can at this point I would say you can gradually also invest in a fund which is a bit of a dynamic one, and I say all seasons. Debt fund is sort of one option that you can do. In fact, you can even do that in a bit of a systematic investment approach, and that could be one way of going about it, because you can gradually increase your debt. Okay. Otherwise, if you are doing lump sum, then you could possibly look at an ultra short term. You can look at either an ICICI, HDFC. You can look at even a short term fund. So I would think the stock between having liquidity in ultra short term. Over a period, you can increase, in the medium term funds and maybe dynamic asset allocation fund. But it's important to look at a conservative dynamic, not asset allocation, sorry, dynamic bond fund is what you can look at, but look at a conservative one.
Okay, well, there you have it. That's then the opinion from Mr. Rego. Aman, I hope you've taken note of that. But with that, we'll not be able to take any more queries today. Don't fret, we'll be back tomorrow and day after as well to answer your questions and queries. In the meanwhile, email them to Ask on the Money Show at etnow.tv and we will answer them over the course of the next few days. Mr. Rego, thank you as well for joining in with your words of wisdom for all our viewers who are right now looking at the market, staring at etnow's TV screens and wondering what's happening to their portfolio. We will take a very short break. Don't go anywhere. We'll be back with lots more on ET Now.